Okay, thanks, Cathal. Just to introduce myself, I'm still Paul. And I'm the last speaker, you'll be glad to know perhaps, and I'm just going to talk about this plain money system of banking. And this is something that Sensible Money are actively trying to get implemented. Now, as I was wrapping up my last talk there, I put up a slide of the money supply going back to the 60s and so on. You might recall it doubled every 10 years until about 2007, and then it kind of faltered and dipped down and so on. So we think that one way or another, this is just the end of the road for this particular system of banking, you know. So with that in mind, where to next? And this is where we would like to see it going. And this is a plain money system of banking. Excuse me. And the idea is that we would separate current accounts from savings accounts. So if you have a current account, your money would be perfectly safe, all right? And ultimately, only you can use it, okay? If you have excess money and you want to invest that with the bank, you open up a savings account, or more accurately called an investment account, and you put money in there. You'd expect that money to grow, and ultimately, only the bank can use it, all right? So this separates the payment system from the investment system. So if such a bank were to fail, it wouldn't be a problem for the macroeconomy, as in all the numbers in people's current accounts would still be there, and they would just move over to the bank of your choice. We seem to have frozen a little bit. I'll see if it catches up in a minute. Just explain a little bit more about current accounts. Part of the transition towards this system is we would declare all bank deposits as legal tender, all right? And the beauty of that is that we would be able to remove all current account deposits as liabilities of the banks. So I think there was a couple of questions earlier about the accountancy procedures the banks would follow and so on. So this would be our little work around the current accountancy procedures. We declare all bank deposits as legal tender, and the money would no longer be liabilities of the bank. It would be the actual money itself, and we would record it off the bank's balance sheet. And now, equally, any debt that you have to the bank would become, is currently an asset of the bank, and any debt from before the transition period, before the changeover, would also be removed as an asset of the banks. And from there, the banks would essentially just start their balance sheet again. So if you did open up a savings account and you put money in there, that would be recorded as a liability of the banks. And if the banks lent that money out, the borrower would promise to pay it back. That would become an asset of the banks. I'll just try and get this going again. Now, if money didn't come from bank loans, where would it come from? Well, we would get the central bank involved, and they would monitor the money supply, and they would ultimately control inflation, and ultimately they would decide how much to create. So they'd look at lots of different things. They would look at inflation in particular. They'd look at unemployment. They'd look at the net money supply, the amount of money in current accounts. They'd look at all our main trading partners and previous increase in the money supply in those economies. They would look at the velocity of money as well. That would be another important one. And ultimately, they would decide how much extra money they think the economy is going to need for the following quarter. And from there, they would just type it into the government's bank account. So at that point, the government would get involved. They would control budgets, and they would decide how best to spend any new money. So in terms of designing a system that's open to as little abuse as possible, we think this is the best that we can do. So first of all, I just want to emphasize that no money would ever be deleted under this system, or very rarely. You know, if the population of an area declined rapidly or whatever, the central bank would look at that and say, okay, we have to delete some money. But that would be a rare enough phenomenon. And as a result, no money would ever be deleted. So whatever money the bank has previously created would remain, and it would just be permanent money that would just permanently circulate within the economy. So it's not like we would always need have this constant need for new money all the time. So the central bank wouldn't actually be creating a huge amount of money over the course of a year. And if you broke that up into 12 months, whatever, each month it would be creating relatively little. So it's not like it would have this huge power to abuse. Equally, they wouldn't even get to decide how to spend that money. They would type it into the government's bank account, and from there, the government would be receiving, again, relatively small amount of money. So it's not like the government would be open to all this abusive spending power. The government still wouldn't be allowed to create money. They still wouldn't be deciding how much money they think the economy needs. That would be left to the experts at the central bank. Now, I want to talk a little bit more about current accounts. So there would be no risk to current accounts at all. If you have numbers in current account and the bank goes bankrupt, it's no problem. You would just choose what other bank for those numbers to appear. So you just swap accounts over. Now, a charge may apply consequently. So that's the sort of downside of that. But the bank will be storing your money completely risk-free electronically. They would be providing this efficient means of payment. And as a result, a charge may apply. If a bank went bankrupt, your balance would just move. Consequently, there would never be a bank run, all right? There would never be an interbank run either, like we had with the Northern Rock scandal. That was an interbank run of central bank money, which is a different type of money. We call this the plain money system of banking because we would effectively be dealing with central bank money directly. There would just be one type of money essentially after this. There'd be no need for deposit insurance as well. Nobody would be worried about whether a bank went bankrupt and so on. And equally, there would never be a bank bailout under this system. If a bank went bankrupt, all the current account money is perfectly safe. It's just whatever is in savings accounts that is at risk. But when you open up a savings account, you would actually be aware that you're opening up an account that is risky. Now, savings accounts aren't as straightforward. A risk would apply, of course, and you would know that. Money would be added to an investment pool. So you'd see your current account go down. In-house, the bank would have an investment pool, essentially, or an investment fund. As your bank account goes down, its investment pool goes up. If a borrower walks in off the street and wants to borrow money, equally, they would lower their investment pool and they would raise that borrower's account, and that's how loans would be processed. So no money would be created through the loan process. Equally, if you repaid a loan to a bank, you'd see your current account go down. In-house, the bank's investment pool would go up. And when the original saver's contract matures, the investment pool would go down and the original saver's current account would go up. And now banks would consult with you before investing, and they'd consult on a couple of different things. So they would consult on what risk level you want your money to go to. So you wouldn't just open up a savings account and throw money in there, and then the bank would use some of that money from the investment pool to go into relatively safe projects and some into risky. And then if the risky one doesn't unfold, they wouldn't split it out proportional to whoever's invested in the bank. You would actually agree what sort of a category you'd like your money to go towards. And as well as that, you could also agree the nature of what you wanted your money to go towards. So if someone wanted to borrow money from the bank to, investigate whether it's feasible to drill for oil or something like that in Ireland, they would have to find a series of investors who are happy enough with that, you know what I mean? Equally, if somebody wanted to develop just some fantastic new gun that could kill loads of people or whatever, they would have to find someone willing to put up money for that before the bank could actually lend. The bank couldn't create the money for the loan. So there's a good opportunity here to have ethical investments. Now, a worked example here of a savings account will explain a bit more. So this is an example of a low-risk, low-return investment. So an example might be housing market loans to middle-income families. And if you open up a savings account and you invest money into this sort of a thing, the bank might charge the borrower perhaps 6% interest. And it might expect a return of 5.8%, and a handful of people will still default, but it's a relatively safe loan. And in the absolute worst case scenario, some flood happens or something like that, they might get a return of just 2%. So in that sort of a scenario, they might guarantee savers a return of 1.5%. So if everything goes according to plan, the borrower pays back 106%, the bank keeps 4.5%, and the original investor gets 1.5%. And these numbers would go up and down depending on competition and so on. Now, an example of a high-risk, high-return investment, so this might be an emerging industry tipped to become much bigger, and no one knows if it's a bubble yet or not. And it might offer 6% to potential savers or investors, and it might expect a return of 10% from borrowers. And if everything goes according to plan, that's what happened. The borrower borrows all the money, they pay 110% back, and the bank splits that profit essentially between the original investor and themselves. And in an absolute worst case scenario, after the bank has collected whatever collateral was agreed and sold that and so on, they might only get perhaps 70% of the money that it lent out. And it might guarantee investors a return of 5%, 75% of investment. That, the bank would have to make up the 5% from their own profits and so on. So under this system, it's quite a natural system in the sense that it's the way most people think the economy works anyway. The central bank would create the entire money supply, both cash and digital. It would be created without a corresponding debt. It would never be deleted. And from there, banks would just deal with existing money only. And the risk of investment stays between the original investor, the bank, and I suppose the borrower as well. Now, we have quite a detailed guide to this system. Again, it's on our website, sensiblemoney.ie, and it's 38 pages long. It explains everything I've just explained there, and it goes into lots of detail on exactly how we would transition to this system over the course of about 25 years or so. And it talks about some potential concerns that we have with our own proposal, like inflation, and if banks were lending existing money, what would happen if no one was willing to invest and so on. So we answer a whole heap of questions like that in this guide. But I'll be happy to take questions on it now, because I know we're sort of short on time. Yeah.